Hey everyone, welcome to another episode of Valuing Stocks, where I pick a stock and try to put a fair value on it. Now, just by way of disclaimer, like I always tell you, do your own homework. This is not a recommendation to go out and buy it without doing your own research. I'm not a financial advisor, and I am certainly not your financial advisor. So, with that out of the way, let's get started reviewing Fitbit and why I think, personally, it looks like it could be an attractive investment, and where the odds may be forever in your favor. So, if we look at this website here, and this service is a service I subscribe to, although you can, I believe, access some things for free or free trial. But the site is called Finbox, Finbox.io. So this is a great service. I've been a big fan since the beginning. They're a startup, but they do some great things with financial data and make it easy for people like you and I to consume. So I'll put a note in the, I guess we don't call them show notes, but below the YouTube video in the description. Anyway, so you can see that Finbox, they have some different financial models and algorithms where they will put a fair value, using different financial models. I'm trying to still figure out how to work this computer. And you can see based on these, they have three different models. So some of them are like DCF, some of them are relative valuation models, like, price to earnings, price to book, things like that. But based on their models, they concluded this value range of $3.74 to $8 and change, and kind of concluded it here, right, which is reflected here. So they're saying it's worth $5.72. Of course, let's do a different color. The stock is currently trading at just above $6, so they're saying it's overvalued. But I, on the other hand, actually think that it is undervalued. You can see from this chart here, the stock was trending, well, this is just since last month, a little bit up, but it had been trending. If you were to look at the chart, it had gone up quite a bit in the last 3 months. But earnings were announced here, and the stock took a pretty big nosedive, and I wasn't happy because I have a investment in Fitbit. But I still think that now obviously it's more attractive to me that now that it's come down. I thought it was still somewhat undervalued before the drop. So let's get into the nitty-gritty of the valuation. Some of you who have watched my other videos know that in those videos I use the spreadsheet, and I actually import data from Finbox.io into those spreadsheets to do my custom valuation. But today I thought I'd show you this Finbox.io tool, or the site, and how it can help you do valuations just on their site without having to import data into a spreadsheet, do a bunch of calculations, set that all up for yourself. And I do have some problems with the site, not technical problems, I mean problems with how they do things, but for the most part I think it's a great alternative. So if you were to scroll down a bit, if you were to choose a model, so this is the 10-year DCF growth exit model, then you would see this right here. But what I've done is I've gone through, and these numbers that are in blue, I have actually edited those. So if it's blue, it means you can tweak it. So I tweak this number here, for instance, because I know now Finbox.io, one pet peeve of mine is that they're uber slow like a quarter behind on getting financial data, which I email them every quarter. It's like, why don't you have Q4 numbers in to your system yet? Because Fitbit reported quite a while ago, but they don't. So this is a projected number in their eyes, but this is the actual 2018 total revenue, 1512, so 1.512 billion. And so you can see that the projection is then for the revenues to grow by about 5% a year is my projection, right? Which isn't crazy. I mean, lately they've had some actually decreased growth over the last few years, but it's not crazy to think that they could actually grow at a minimal rate in the future if they can be the number 2 player behind Apple in wearables, right? Wearable technology. So if we look at this, you can see there is a EBITDA margin, and they start with that number. So we're projecting on EBITDA margin. See, it's negative in 2017, negative in 2018, and then turning positive and ultimately getting at a 10% EBITDA margin, right? And so then down here, you can see these EBITDA numbers that were up there, right? And to get to free cash flow, which those of you who are familiar with discounted cash flow models know that it's all about what's the projected free cash flow, right? So we're discounting future cash flows to the present, back to the present, and adding those up to come up with a fair value for the entire company. So these are just the calculations that you go through to get there. So you subtract out the D&A, right? That just gives you EBIT, which is basically operating earnings. So earnings before interest and tax. As you can see, negative, but maybe in the near future turn positive, which is great to have actual profit. You got taxes to come out. So after taxes, you've got your net operating profit after tax. That's what NOPAT stands for. And then you've got your capital expenditures, because capital expenditures are what you spend on things that are going to last longer than a year. So like you buy a piece of equipment, or you buy a building for your employees to work in, right? Those are capital expenditures. You buy some like machinery, things like that. So what you got to do, so this number here isn't necessarily the amount of cash the company has. What you got to do is you got to subtract out what cash is spent on capital expenditures. This is your net working capital investment. We can talk about that another day, but a lot of times that makes minimal impact on a DCF valuation, especially for some types of companies. And then you've got your depreciation and amortization up here that you subtracted out. You're adding it back in because remember, depreciation and amortization, that's not a cash expense, meaning cash doesn't actually flow out of the business for that expense. That's just what accountants like to be on the books, because in the real world, buildings wear out, machinery wears out, and so you should wear those things out over time and expense them over time, because eventually you're going to have to get a new machine or a new building. So after we do those calculations, we get negative 132 million of free cash flow, for example, for 2018. Remember, this was their projection, so they don't have the full year 2018 data in. We actually know the actual number now, and it was actually better than this. So for 2019, though, based on our model, we're projecting still negative free cash flow here, but then starting in 2020, and we're all about the future, it starts climbing, right? And so we got 8 million, 29 million, it starts to build and starts to snowball as those EBITDA margins expand, as fixed costs remain fixed, and as revenue ramps up, right? And then ultimately 10 years from now, we're sitting at 102, so let's just call it $100 million of free cash flow. And what is free cash flow? That is what it says. It's free to be used by the company however it wants. It belongs to the shareholders though. And so the company, ideally, in an ideal world, and good management does this, will figure out a way to get this free cash flow back to shareholders every year, whether it's in the form of dividends, right? Whether it's in the form of reinvesting into the business, creating new products, and pumping up, maybe R&D or whatnot for new products, or acquiring another company that is promising, that's a good buy. Don't want them to do that, they're going to overspend. Or what I like is if management can actually repurchase shares while the shares are cheap, that creates a lot of value for shareholders. It shrinks the total number of shares outstanding and makes your piece of the pie bigger, right? If total shares outstanding decreases, then your proportion of those shares increases. So I'm not going to go through all of these different tabs, but there's different tabs and these different calculations. Skipping to calculation enterprise value. So remember we had all of those cash flows. Now we're doing this vertically. Start out negative, growing. The free cash flow is growing, right? Until finally, here was like the 100 million after 2027 was 100 million a year. Well, we're going to discount this back at a discount rate. So we're assuming these are discount rates up here. So we're assuming an 8% in our mid-range scenario discount rate, 8.5% low, high 7.5%. What discount rate is what the rate of return that shareholders are going to expect from an investment in a stock like this. Okay? But you got to think of it as in a diversified portfolio. So if somebody has 500 stocks and this is just one of them, probably an average over their entire portfolio for their stocks, maybe they want an 8% return, which is a kind of the average return of the stock market over time, right? So what we got to do is we discount these free cash flows by 8% or 8.5%, 7.5%, and we get a range of numbers. So at our middle discount rate, the present value of adding these all up, which are discounted back to present value, that's why this is smaller than this over here, we get $240 when we add this column up, right? And then we need to do some math, some fancy math, actually not too fancy, it's pretty easy to figure out, all right, after 2027, what's the value of all the cash flows after that? We know for the next 10 years, the value of the cash flows is about 240 million. Going forward into perpetuity, that's what they call it, what is the value of, generating 102 million every year into oblivion, right? And you got to discount that though at the because we're talking 10 years from now, so we got to discount it back 10 years. So that's basically you multiply this by 48%, right? 48% of that is you're going to get a free cash flow number. It's not listed here. And then what you do is you do some funky math where you take whatever, roughly 48% of this is roughly half, so like let's say 50 million. You take 50 million divided by, and what you do is the discount rate, so 0.08 for 8%. Here, I'm going to actually just write this out for you, okay? So you're going to take, say roughly 50 million is the discounted cash flow, and you're going to do 0.08 minus, see this selected perpetuity growth rate right here, 2%, so you're going to minus that 2%, right? And so you're going to have 50 over 0.06, right? Let's pull up my calculator here. Let's see if I can drag this into the screen. 50 divided by 0.06. Let's figure the right number. All right, well, because I didn't know what the exact, after we discount this 102, I was estimating 50. It's not really, but it's pretty close. So you see my 833, pretty close to 842. That's just because I didn't do an accurate calculation up front. But, so that's where you get this number from this calculation here. So we're saying 842 million is what the company's worth going into perpetuity after 2027. But you take this number here, add it to this number, and you get this number, which is $1 billion, right? $1.082 billion. Okay, so we were calculating the enterprise value, and enterprise value is an interesting definition. It's not interesting, it's just an important definition. So there's enterprise value and there's market cap. So a stock's market cap is not necessarily their enterprise value. Enterprise value is the value of the total business, the whole enchilada, not just the equity portion. So if you are to think about your home, and let me pull up a whiteboard. So if you're think about real estate, right? So you got a home, okay, and you may owe $300K on this home, right? That's how much debt you have, your mortgage, right? But you put in a down payment of 100K, so you have 100K of equity in the home, right? And so the home is worth, let's say, 400K. This would be like your enterprise value, okay? This equity piece right here is when we say market cap, we're talking about the equity value of a stock. And so some stocks with a ton of debt will have a way higher enterprise value than market cap. But most stocks, I mean, probably most in the universe of stocks, aren't going to have more than like half debt. So, and the best ones, my favorite ones, are ones like Fitbit that basically are debt free and have excess cash. Okay, so now I'm back over here at this Finbox.io. I'm going to click on Equity Waterfall. So this is going to show you. So enterprise value, right, we calculated here $1 billion-ish. And then what we got to do to get to the value of common equity, which is the same as the market cap, so we got to add the cash and equivalents. We got 378 million of cash, and actually they have more now at the end of Q4, I believe. So it's probably higher. And then they've got investments. These are not quite as liquid, but other investments that they could sell off and generate cash, 280 million. And normally, and then you would subtract out debt, right? Like in that house scenario, we would subtract out the debt to get to our equity. But we don't have any debt on this company, which is nice. It means the debt holders can't steal this company away from us, even if we're driving it into the ground, right? At least they can't take it from us. Minority interest, those are preferred stock. That's something we can talk about on another day. Most companies don't have those. And so you get to this value of the equity. So you're basically adding these two. So it's now 1.74 billion, right? So that's the total value of the enterprise. Like if you wanted to buy this company, you're a rich dude, just wanted to drop 1.74 bill, you could buy this company for that much. And then your shares outstanding is 241 million. So you take this number divided by this number to get the per share value, right? And according to the math, the stock is worth, based on these assumptions, my discount rate, my revenue growth, all that, which you can see there's a lot of assumptions that go into valuation. So that's why valuation is a tricky thing. It's not so precise. $7.21. So at today's price, it means you could still have 32% upside. You can make 32% if you bought it today. If it went up to this, what I'm saying is my guesstimate of fair value, you make 32%, which is a nice return, right? On the high end up here, it could be as high as 49% return. On the low end, 20% return. So I hope that was helpful. You kind of get to start to learn how to value different stocks. And it's important because if you find consistently undervalued stocks, you get pretty good evaluation, you can make money. It's what I always tell people, investing is the ultimate side hustle. And I'm going to do some more videos in the future to teach you how to propel yourself forward with the side hustle without having a ton of capital, right? Because if you just are buying the shares of stock, then it's a good side hustle. You can make money, but there's some tricks you can do, not tricks, but some strategies you can do with options where, and that's how I've done it. If you don't have a lot of capital to start with, you can really start to build capital with just a 10% move in the stock. You can really make a lot more than 10% on your money. And so if you are interested in that, I'm going to start making videos to teach you how to do that in a nice, responsible, cautious, risk-averse way, right? So subscribe to this video. I hope to be able to kind of hold your hand along this journey. Feel free to comment. I love responding to comments. And next time, we will bring you another stock. And actually, I think I'm going to do a second video on Fitbit because there's a lot more I wanted to cover. I wanted to cover recent news. I want to cover Citron's coverage of Fitbit. So I think we're going to have to build that into another video because these just fly by and I'm already at 22 minutes. So I should just stop now and quit talking.